Rohit Srivastava, fund manager with Sharekhan, is with us. Rohit, thanks very much for your time. Good morning. We spoke 2 or 3 days back, and you said even if the vote is to leave in Britain, the negotiations would be long, prolonged. The final impact would be a lot more diluted. You stick with that? You stand by that statement? So, in that sense, then market reaction is exaggerated.
Well, because it's going to be a long-drawn process, the market might start, like you're saying, yes, it might appear exaggerated, and over the next couple of days, as we start digesting that, it's going to take time, and maybe things will not be as bad as they appear. The markets might rebound a bit, but once we are done with that, then I think you'll start looking at the economic reality of the markets themselves, which is, how the economies are doing, how the business is doing. You have slowing growth, and you'll go back to those issues, which are not exactly positive in any case. So I think this event essentially has, created the reaction, which is, part of, it's come unfortunate to probably those who are, not pricing in the downside risk, but essentially I think the markets were peaking out, which is what I was saying last time, and in that sense, we've just sold off. In fact, if you look at, European markets themselves, they did not go beyond the May high. They've only made one lower high yesterday. If you just look at even the DAX, one lower top between April, May, and June, and then this is a second lower top that we made yesterday. So essentially the markets were heading slowly lower, but they became very volatile because of this event. And the reason for that was essentially economic weakness. So that was the point, and this event has essentially speeded up the process of that of the unwind. But because the event itself means that yes, it will take time. This is not going to happen overnight. If there are discussions, the best reference I think for this is going to be is the Brexit itself. If you just go back a year, and that was again June, they voted 66% against the aid package that was being given to them, and still the parliament decided to stick with the package for another 3 years and try it out. So between what the public votes and between what the politicians think is right in terms of the overall financial environment can be very, very different, and I think that's the standoff that you're really seeing right now in Greece, whether it's Britain, and now if you've seen the opinion polls, even Italy, Portugal, many of these countries want referendums to essentially vote on the EU issue. And so the public mood essentially is, they're tired. They want out of the sort of depression that they have been going through in terms of their economies, even though you've tried to boost it up with all kinds of measures. Essentially, the public at large is voting out of the depression that they've been going through. But the politicians, or the politics of it all, is because of the financial risk involved with a move in that direction. They are trying to hold things together. Greece tried to hold things together despite the public vote. The British might also try to hold things together despite the public vote. The question is, it creates an uncertainty for several months as you watch those discussions and debates, and see how much is diluted and how much is not, and then the markets start to price that in. But as long as that uncertainty persists, I guess the markets are not going to, in general, like it.
Okay, so I'm going to ask you to make some forecasts. How much downside do you think global markets have? Say, let's take the MSCI World Index, for example.
My sense is that, and I try to use the ADR index as well, which very much reflects the MSCI World Index. And my sense is that the lows that they made in February could very well break. I think that signature was there on the charts a week back, which is where we were discussing, and I was saying that we are not looking at what is happening in the world markets. A lot of the European markets were essentially signaling that they were reaching breakpoint, especially the peripheral markets. So you had signs that you could start another leg down, which could actually go below where we were in Feb of this year. And the rally which had occurred was essentially on the back of a weak dollar, And that rally, that sell-off in the dollar was essentially complete, even though we did see some selling in the dollar in the last week. We've not gone below the point where we were maybe a month back. So the dollar had started to move up again. And of course, today's move is pretty big in terms of a one-day reaction. And even if there is some intervention and it pulls back, my sense is basically the dollar is heading higher from here, irrespective of any intervention that comes in on the pound. And in that sense, we've reversed the trade that happened between Feb and May. And we are looking at a stronger dollar. We're looking at weakness coming back to most equities, which could again go back to test those lows. And I think that could mean even for the Nifty something similar, because anybody who was projecting that the Nifty is in a bull run or it's a bullish case, most of them were looking at the higher top, higher bottom structure that the market was trying to develop since it bottomed at 68.25. And today's fall, by going below the high that we made in the month of May, which was at around 7992, essentially the entire rise gets overlapped. In an Elliott wave sense, to anyone who follows Elliott waves, it means that it confirms that this entire structure was a bear market rally. Something that I've been saying over again, today's fall essentially confirms that. And it means that you can basically retest the lows that you made. If not, the best bullish case would be that you get a retracement of the entire rise, which could mean up to a 61% retracement of the entire rise in any case, which means going back to somewhere around 7,500 to 7,300, even in a retracement. So I think that's the overall picture. Now, that doesn't mean that it happens tomorrow morning. It's possible that, as news comes out, if there could be bounces in the market from time to time. But I think the overall trajectory would probably be down from here, with 7,300, the high that we made, being the top for the market for a couple of months.
Sure. So, I mean, people with our viewers are mostly retail, and if they have they've invested over the last 1 year or in February, after February along this rise, what's your advice? Not traders, right? But people who've invested at various levels. What's your advice? I mean, if that is your view, give your portfolio another serious relook.
I think, we've discussed that this market has been about a narrow list of stocks, so it's never been broad-based, which means that if your portfolio has those, 5, 6, 10 stocks that are essentially been doing well in this market, then you're essentially riding it out, because despite sell-off, some of these stocks have held on. And if your entry price is far lower, then it's a completely different scenario for a long-term investor. But most people would have a diversified portfolio. They would probably own 50, 100 stocks. And many of them would be non-performers. And if you haven't really re-looked at it up till now, then probably it's one more opportunity to actually re-look at it and adjust to that extent. Consider hedging strategies, consider diversification into alternate assets like gold, which I've been recommending for quite some time. Maybe even have some long dollar positions. So those are things that you should consider. Most people don't consider these alternate assets. But if you're purely in equities, one thing that I've been writing and I've spoken about in the last week is that the biggest moves were essentially coming in the last week in the small cap and mid cap segments, and I thought those were the most dangerous. So I think you need to be very, very careful about what you own in those segments. If you just bought something on hearsay, then you should definitely consider, booking out, or at what level you want to, manage your risk in terms of losses, because I think the next sell-off that is coming in the market would be most painful on the small and mid-cap segments that have been hot throughout most of last year, and that's the segment that you'd really need to manage with some kind of a stop loss or level that you want to close your positions at.
Rohit, thank you very much. It's a pleasure. Good having you here.